are 2.2 million property investors in Australia, and most of them have a home loan and an investment loan running at the exact same time. And almost all of them are managing both of those loans exactly the same way. But the problem is your home loan and your investment loan are absolutely not the same type of debt, although you've been treating them the exact same way. In this video, I'm going to show you exactly how to structure both of those loans, which debt you should be attacking first, and why getting this right early can save you well over $200,000 in interest and get your home paid off over 8 years faster. My name is David, I'm a mortgage broker and I work with investors all across Australia, and if you're finding my content useful, please hit the subscribe button. I'll keep making it well worth your time. Before we look at any of the numbers, I need to make one distinction absolutely clear because it is the foundation of everything we will be talking about today. Not all debt is the same type of problem. Your home is what we call non-deductible debt. That means the interest that you are paying on it comes out entirely from your after-tax dollars. The property produces absolutely no income, which means there's no tax offset, and every dollar of interest is pure cost. The interest on your investment loan may be claimed against the income that property generates, and in many cases, it could potentially be offset against your personal income as well. This is the level 1 version of what negative gearing actually means. But as always, confirm the specifics with your accountant. This is an overall lesson on how things are supposed to be structured and what the types of debt are, not specific tax advice. But the principle is pretty simple. The taxman will help you carry your investment debt. Your home loan, he isn't. He really doesn't care. So the first rule of debt structuring is incredibly simple. Get rid of the debt that the ATO will not be helping you with and be really strategic about the debt that it will. The tool that lets you be strategic about your investment debt is what's called interest-only repayments. Every mortgage has two components: the principal, which is the actual loan balance itself, and the interest, which is the cost of the borrowing. On a principal and interest loan, every repayment is chipping away at both of those things. Your balance is reducing month by month. On an interest-only loan, your minimum repayment covers just the interest itself. The loan balance stays flat and unchanged. But I'm going to show you a quick example on how these interest-only and principal and interest repayments actually work. So on principal and interest repayments, you need to imagine your repayment as this rectangle just here. This rectangle will not change for the remainder of your loan term, and it is split into two parts. It will be your principal and it will be your interest. So from here, whenever you make a repayment, you make your rectangle. A portion of it will go towards your principal and a portion of it will go towards your interest. If you have any money in your offset account, all that's going to do is fluctuate this line just here. The more money in your offset, the more principal you will be then paying off with every repayment. But when we look at interest-only repayments, this is just the interest portion, exactly what it sounds like. And if you have any money in your offset account, this will just reduce your interest repayment altogether. So this is where you can actually reduce your repayment and improve the cash flow of your property. This is a really basic way to look at principal and interest-only repayments. Interest-only isn't a way to avoid your loan, it's a very deliberate cash flow decision. When you're on interest only for your investment loan, like we showed in the example just before, your minimum repayment is always going to be lower than if you were paying principal and interest. Month by month, you'll have a little portion of cash flow you can direct somewhere else and not have it locked away inside of your investment loan. And where you send it is what determines whether this strategy is working for you or not. So let's go through the numbers on a cash flow comparison with scenario A and scenario B. So we have the exact same investor. We have the same two properties. We have an investment property worth $700,000, a principal place of residence, which is also worth $700,000. And then we have our debt against both of them, which is an 80% loan to value ratio with $560,000 worth of debt across the both of them. So when we look at scenario A, we look at something very, very specific. Both of those repayments are sitting on principal and interest. On your investment loan, you're paying $3,282 a month. On your home loan, you are also paying $3,282 per month. Your total monthly spend, $6,564, and your cash flow or extra cash flow from that money spent, we're going to determine at 0, which means your home loan or your principal place of residence loan is 30 years long, and the interest you're paying on that mortgage is $622,000. A simple change into scenario B, which is the preferred scenario, is going to look a little bit like this. We are going to have our investment loan sitting at interest only. You're paying $2,819 per month. And one little distinction is that generally the interest rate over here is going to be 0.1 to 0.3% higher than if you were paying a principal and interest loan on your investment property. That is because banks will load a little bit of a premium on interest only because they determine that type of repayment to be a luxury for investors. But I digress. When we look at all of this, it looks a little bit like this. We have our home loan, our principal place of residence. We are also paying $3,282 just like before, but that spare cash flow of $463 per month, we are redirecting it into this loan just here. What that's going to do is have our home loan or our principal place of residence loan paid off in around 22 years. And with just that simple tweak, we are going to have the total interest paid or total interest saved, to be around $200,000. And the only difference we made was the type of repayment you'd be making on your investment loan and where you're going to strategically put that extra cash flow when you have both home loans running side by side. So you might be asking, why does this work and why is hammering your home loan the right call? So let's get back to what we established right at the beginning. Your home loan interest is non-deductible. Every dollar of that interest is costing you in after-tax dollars, with no tax offset and no help whatsoever. Your investment loan is deductible. The ATO is partially subsidizing the cost of carrying that debt. That makes it way cheaper for you to hold. So the logical move ends up being keep your deductible debt as long as it's working and get rid of your non-deductible debt as fast as humanly possible. If you want to learn how to pay off your home loan a lot faster, you can look at this video here that I've already made on that same topic. But there's also another reason we like to do this, because once your home is fully paid off, you can still use that security. The equity in your home becomes the engine for your next purchase or the supercharger to your investment portfolio. You can continue to borrow against that property, and that new debt, because it is investment purpose, becomes deductible. So as you can see, it doesn't actually matter what the debt is attached to or what kind of security the debt is attached to. It's all about the purpose of the debt itself. Paying off your home loan faster isn't just about saving interest. It's about having another security in your back pocket to be able to continue to leverage to build your property portfolio. The end goal to all of this is to have all debt you hold under your name to be productive debt. This means your home loan or any debt that was taken out for owner-occupied purposes completely and utterly gone. The only loans you will have remaining will be your investment loans, which means they are all tax deductible, all attached to income producing assets or for the purpose of purchasing an income producing asset. Now, when we talk about interest only loans, these terms typically run up to 5 years. When they end, your loan is going to revert to principal and interest over the remaining part of that term. So if you had a 30-year loan term with 5 years interest only, you're only going to have 25 years theoretically to pay off that debt, which means your repayments could spike once it goes back to principal and interest by 30 to 40% very, very quickly. The fix for this though is to plan for it well in advance. Save the cash flow difference inside of your offset, or reapply for another interest-only term if your income allows for it, or just prepare for these higher repayments before it arrives and takes you by surprise. When you have interest-only loans, if you don't have a solid plan, they can go from helpful to harmful in an absolute instant. There are 3 questions I work through with every single client before recommending a structure to begin with. So let's run through them together for your situation. Question 1 is, what is the purpose of the property? Is the property a long-term asset? Is it a stepping stone into property number 2? Is it a cash flow vehicle when you're getting a lot closer to retirement? If it's a stepping stone or a growth asset, interest only on an investment loan and extra payments on the home loan is generally the right structure. If it is a cash flow asset closer to retirement, you probably want to get rid of that debt pretty quickly. That way you can enjoy the cash flow of that property into your retirement age. Question number 2 is, what does this decision do for your borrowing runway? A borrowing runway is how many more properties you can buy before the bank says no. I will be producing a video on this very soon. It's a very complex one, so bear with me while I do that. Interest only keeps your monthly commitments a lot lower and allows you to cash flow these properties a lot better. However, when we extend out to a 5-year interest only term, like I said a little bit earlier, that gives you much less time to theoretically pay that debt off because you have taken a 5-year period of paying no principal off whatsoever. This can become harmful for your borrowing capacity if you aren't very careful, and this is where we go into the realm of 2nd and 3rd tier lenders to be able to get more investment debt, because they're going to look at the way that you cash flow your properties very, very differently to the major lenders out there. And question number 3 is that, do you have a clear plan for the cash flow difference? This is the one that separates a very good interest-only decision to an extremely lazy one. If that extra $463 a month that we spoke about before just gets absorbed into your lifestyle spending, you've gained absolutely nothing. And if anything, you've put yourself further behind. The most useful places that money can go is either straight into your home loan itself or straight into the offset account attached to your principal place of residence, because what that's going to do is leave a little bit of flexibility for later if you want to use that money for a deposit on an upsizer property, or you want to use that money to debt recycle, which is another video which will be coming out next week. Now, of course, all of this is very high level education and very high level guidance. If you want to look at your situation specifically, reach out to me. There is a link in the description below. As I said, I work with investors all across Australia and I look forward to helping you build your property portfolio.